Imagine you are at a poker table. You've been playing for hours. The guy sitting across from you, the one who has won every major hand for the last 30 years, quietly slides his chips off the table. Not dramatically, no announcement, he just stops playing. You would pay attention, right? That is exactly what is happening in the stock market right now. Warren Buffett, the man who has navigated every major financial crash since the 1950s, has quietly moved over $325 billion into cash. $325 billion, sitting on the sidelines. And he is not alone. Over the next 12 minutes, we are going to look at exactly what is happening, why some of the world's most successful investors are repositioning their wealth, and, most importantly, what you can actually learn from it. No panic, no doom, just the data and what it honestly means for your financial future. Let's get into it. Let's start with facts, because facts matter more than fear. Over the past 2 years, Berkshire Hathaway sold approximately $234 billion worth of stocks. Their two biggest moves, reducing Apple from nearly 50% of their entire portfolio down to under 25%, and selling over 250 million shares of Bank of America. Jeff Bezos sold around $14 billion in Amazon stock between 2024 and 2025. Mark Zuckerberg sold close to $3 billion in Meta shares, and Jamie Dimon, CEO of JP Morgan Chase, sold company stock for the first time in 17 years. Now, before we assign a dramatic meaning to all of this, let's ask an honest question. Is any of this actually unusual? The answer is, sort of, but not entirely. Corporate insiders are almost always net sellers. They receive huge portions of their compensation in company stock, and at some point, they need to convert that into actual usable money. So insider selling, by itself, is not a red flag. What is worth paying attention to is the scale. The sell-to-buy ratio among corporate insiders hit nearly 20-to-1 in some months of 2025. For every $1 insider spent buying their own stock, they sold $20 worth. That is elevated, and it deserves a clear-headed explanation. Let me give you the 4 most credible explanations for what is driving this. Reason 1. Valuations are historically stretched. 2 widely respected tools measure whether the stock market is cheap or expensive. First is the Buffett Indicator, total U.S. stock market value divided by GDP. It is currently above 200%. Historically, anything above 150% signals the market is expensive. Above 200% is genuinely rare. Second is the Shiller PE ratio, stock prices compared to average earnings over the past 10 years, adjusted for inflation. It is currently around 38 to 40. The long-term average is closer to 17. Does this guarantee a crash? Absolutely not. Markets can stay expensive for years. But it does mean future returns from current price levels are likely to be lower than what history might suggest. Sophisticated investors understand this math. Reason 2. Tax timing. The Tax Cuts and Jobs Act of 2017 set long-term capital gains rates at 20% for high earners. That legislation was scheduled to expire at the end of 2025. For someone sitting on tens of billions in unrealized gains, locking in today's rate before it potentially rises is simply sound financial planning. This is the same logic any homeowner uses when they refinance before rates increase. It is not sinister, it is practical. Reason 3. Concentration risk. Bezos holds most of his net worth in Amazon. Zuckerberg's wealth is overwhelmingly Meta. When your financial life is tied to a single company, even a great one, responsible advisors will always recommend gradual diversification. Selling does not mean they think the company will fail. It means they are managing risk intelligently. Reason 4. Berkshire's scale problem. This one is specific to Buffett, and it matters. Berkshire now manages so much capital that finding investments at the scale they need is genuinely difficult. To put $50 billion to work in a single stock, you need a company large enough to absorb it, and there are very few of those. Buffett has spoken about this constraint publicly. The cash pile may partly reflect that Berkshire has simply outgrown the available opportunity set, not necessarily that Buffett is predicting a catastrophic crash. Now let's zoom out, because there is a structural trend worth understanding that goes well beyond any single investor's decisions. Baby boomers, born between 1946 and 1964, currently hold an estimated $78 trillion in wealth. As they age, that wealth will transfer to millennials and Gen Z. Estimates suggest somewhere between $70 and $90 trillion will change hands by 2045. This is the largest intergenerational wealth transfer ever recorded. Here is why it matters for the stock market. A massive portion of boomer wealth sits inside the market, in 401ks, IRAs, pension funds. As boomers retire and begin drawing down those accounts, they naturally shift from buyers to sellers. They need income, not growth. They move out of equities and into bonds, annuities, and cash. This creates a long-term structural headwind for stock prices that did not exist in previous decades. The same demographic wave that powered the bull market from the 1980s onward, tens of millions of workers in their peak earning and saving years, is now gradually reversing. For younger investors, this is genuinely useful context. The strategy of buying index funds and holding forever has a strong historical track record. But the next 20 years may look meaningfully different from the last 40, not because anything is broken, but because the demographic engine that drove those returns is shifting. That does not mean you should not invest. It means you should understand the environment you are investing in. If large investors are trimming stock exposure, where is the capital actually going? Gold. Central banks bought over 1,000 tons in 2024. Gold functions as a hedge against inflation, currency weakness, and geopolitical uncertainty. Family offices, the firms that manage money for the ultra-wealthy, have been quietly increasing allocations here. Real assets, industrial real estate, data centers, logistics infrastructure, physical assets that generate consistent cash flow and hold their value through economic cycles better than paper assets often do. Private markets. Moving capital into private companies reduces exposure to daily public market swings. Private investments are valued differently. They do not fluctuate every second the way public stocks do, which provides a form of insulation from short-term volatility. Short-term treasuries. Buffett's $325 billion is largely sitting in T-bills, earning around 4 to 5% annually. When the stock market might return 6 to 7% with meaningful downside risk, earning 4 to 5% with essentially zero risk is a genuinely rational trade-off, particularly at the scale Berkshire operates. The theme running through all of these moves is the same: preserve capital and maintain the ability to act when better opportunities emerge. These are not necessarily predictions that everything will collapse. They are positioning decisions made by people who have learned to protect what they have built. Let's make this practical, because that is the only reason any of this matters. If you are in your 20s or early 30s, a market correction is actually your ally, not your enemy. You have time. A 30% decline that takes 5 years to recover is not a disaster at your stage. It is a buying opportunity. Keep investing consistently. Your biggest risk is not a crash. It is sitting in cash for years waiting for one that might not arrive on your schedule and missing years of compounding in the meantime. If you are in your 40s, review whether your portfolio has drifted toward heavy concentration in any single sector. Technology has performed so well over the past decade that many investors now have a much larger tech weighting than they intended. Rebalancing periodically, moving some gains into other areas, is not market timing. It is normal portfolio maintenance. If you are in your 50s or 60s, sequence of returns risk is real and it deserves serious attention. A major decline in the early years of retirement can permanently alter your financial trajectory because you are withdrawing money while the portfolio is falling. Having 1 to 2 years of living expenses in cash or short-term bonds creates a buffer, allowing you to cover costs without being forced to sell depreciated assets during a downturn. For everyone, base your financial decisions on your own situation, your timeline, your income, your actual goals, not on what a 94-year-old managing the world's largest investment company is doing. Buffett's position makes sense for Buffett. His constraints and yours are completely different. Use insider activity as one data point among many, not as a reason to panic, not as an instruction.
Here is what I want to leave you with. The pattern of sophisticated investors repositioning quietly while everyday investors stay fully committed. It is real, it is documented in public filings, and it is worth understanding clearly. But the takeaway is not to be afraid, and it is not to copy anyone blindly. The takeaway is to actually understand what you own and why you own it. Ask yourself honestly, is my portfolio built around my real financial life, my timeline, my income needs, my actual risk tolerance, or am I just holding what everyone else holds because it felt like the obvious thing to do? The investors who consistently navigate market cycles well are not the ones who predicted every downturn. They are the ones who had a clear, honest plan before things got difficult and followed it. That kind of financial clarity does not require $1 billion. It requires a few honest conversations with yourself and maybe with a good advisor. Review your allocations, know your timeline, build a reasonable cushion, and stop letting fear, whether it is fear of missing out or fear of losing what you have, drive decisions that deserve more careful thought. Both kinds of fear are expensive over time. Stay educated, stay calm, and build a financial life that is actually pointed toward where you want to go. Thanks for watching, and if this gave you a clearer way to think about your money, share it with someone who could use the same perspective.